All right, class, welcome. Today, we're diving into a topic that is, well, it's absolutely essential for anyone serious about business in Canada.
We're going to crack the code on a really critical topic for any future business owner or tax professional, the associated corporation rules. Understanding these rules is really the key to structuring a business for maximum tax efficiency. So believe me, you're in exactly the right place.
So here's our game plan. We'll start with the big incentive. Then we'll decode what corporate control really means, walk through the 5 specific rules, apply them in a practical example, and then we'll wrap up with the key takeaways.
Okay, let's just dive right in. To understand the why behind all these complex rules, we first have to understand the powerful motivation for wanting to get around them in the first place.
This right here, this is the magic number. It represents a huge tax-saving opportunity for Canadian businesses. But, and this is a big but, the government has built a pretty complex web of rules to control exactly how you can use it.
So that $500,000, that's the annual limit for something called the Small Business Deduction, or the SBD. It's a massive incentive, and it's designed to leave more cash in a company to help it grow, hire, and expand. Now that brings up a pretty logical question, doesn't it? If your business is successful and you're hitting that limit, why not just, spin up a second company or maybe a third and get another $500,000 limit for each one? Well, let's just say the government is way ahead of you.
And that brings us to the government's playbook for stopping businesses from just multiplying that tax break. It all comes down to one single powerful concept.
The rule, in principle, is actually pretty simple. If the Canada Revenue Agency decides 2 or more of your companies are associated, they don't each get their own limit. No, instead, they are forced to share one single $500,000 SBD limit between all of them. And just like that, the whole strategy of creating more companies for more tax breaks, it's gone.
So, here is the absolute crucial point. This entire rulebook, this whole framework, it all hinges on one single word: control. I'm telling you, if you can truly understand what the CRA means by control, you can master this entire topic. It is the absolute key to everything.
You see, the definition of control is intentionally broad. It's designed to catch a huge variety of business structures. First, there's de jure control, which is the legal control you get through voting shares. Then there's de facto control. This is control in practice, through influence, even if you don't have majority ownership. And finally, there are specific deemed control situations that are written right into the law itself.
Now, for de jure control, this case, Buckerfield's, gives us the landmark legal definition. It basically establishes the classic test. Do you own enough voting shares to elect the majority of the board? This is the most straightforward type of control we'll talk about, but really, it's just the beginning.
All right, now let's get into the technical playbook. The Income Tax Act lays out 5 specific rules to figure out if companies are associated. We're going to walk through each one step by step.
Think of these 5 rules as the specific application of that broad concept of control we just talked about. They're like different lenses the CRA uses to examine a corporate structure.
Okay, Rule 1 is the most direct. This is your classic parent-subsidiary relationship. But what's really crucial here is the domino effect. If Corporation A controls B, and B in turn controls C, well, the rules say A is also associated with C because of that indirect control. It creates a chain reaction.
Next up, Rule 2. This one happens when 2 different corporations are controlled by the very same person or the same group of people. And here's a really key detail to remember. For these rules, a shareholder needs only 1 share to be included in a controlling group. Yeah, the threshold is surprisingly low.
Rule 3 is all about family. So if you control one company and a relative, say your son, controls another, they aren't automatically associated. There's a catch. The key is what we call cross-ownership. One of you has to own at least 25% of the other's company. That's the link the CRA is looking for.
Rule 4 kind of builds on this. Imagine one person controls company A, and a group of their relatives controls company B. For them to be associated, 2 things have to be true. First, the person controlling company A has to be related to every single member of that group controlling company B. And second, that same person must also own at least 25% of company B. Both conditions have to be met.
And finally, Rule 5. This one is the most complex, for sure. Here you've got 2 different corporations, and each one is controlled by a separate group of relatives. Now, for them to be associated, a whole bunch of things need to happen. 1, every member of the first group must be related to every member of the second group. 2, there has to be one person who is a member of both of those groups.
And 3, that common person has to own at least 25% of both companies. It's a high bar, I know, but it's designed to catch those really intricate family business structures.
Whew. Okay, that was a lot of theory. So now, let's bring it back down to the real world and see why this stuff actually matters. Let's look at how these rules affect a very, very common business decision: expansion.
This slide right here, this perfectly illustrates the impact. Look at Structure 1. Your company owns 60% of a new venture. Well, that's clear de jure control. The result? The companies are associated and they have to share one SBD limit. That means the new company's profit gets taxed at a much higher rate. But look at Structure 2. You bring in a partner and you each own exactly 50%. Now, neither of you has control. The companies are not associated, and bam! They each get their own full $500,000 SBD limit. Just think about that. A 10% shift in ownership can dramatically boost the new venture's cash flow. It's a total game changer.
So let's wrap this up and synthesize everything we've covered. If you remember nothing else from this explainer, I want you to remember these crucial points.
First off, the SBD is an amazing tool. Second, the entire reason these rules exist is to stop people from multiplying it. Third, control is the absolute name of the game, and its definition is incredibly broad. Remember, de jure, de facto, and deemed. And most importantly, how you structure your business has huge, enormous tax consequences. A little smart planning up front can mean a whole lot more cash in the bank later.
So, I'll leave you with this one final question to think about for your future careers and ventures. As you grow and start new businesses, are you consciously building a structure that maximizes its potential? Or are you maybe building one that's accidentally leaving a whole lot of money on the table? The answer, as you now know, could have a massive, massive impact on the bottom line.